What if I told you that the rules of the stock market were just secretly rewritten, specifically to help one company dump billions of dollars of stock on retail investors? And what if that company was SpaceX? Now, before you dismiss this as conspiracy theory nonsense, hear me out. Because this isn't about whether SpaceX is a good company, it absolutely is. SpaceX has done things that seemed impossible. They've revolutionized rocket technology. They've created Starlink, which is bringing internet to remote parts of the world. Elon Musk is genuinely a visionary entrepreneur. But, and this is a big but, there's a massive difference between a company being good and a company's stock being a good investment at a particular price and time. And the SpaceX IPO, this is one of the most carefully constructed wealth extraction events I've ever seen. Let me start with the rule change, because this is where the story really begins. The Nasdaq has had IPO listing rules for decades, literal decades. These rules were designed intentionally to protect retail investors from getting destroyed in IPOs. They set minimum financial thresholds. They required companies to meet certain profitability standards. They slowed down the process. They gave time for due diligence. And you know what? Those rules worked. They protected a lot of people from losing money in bad IPOs. But here's where it gets interesting. Just before SpaceX decided to go public, the Nasdaq changed those rules. Not just tweaked them, not just updated them for modern times. They fundamentally altered them in ways that made it possible for SpaceX to go public as a special case. Think about that for a second. The rules existed for decades. They were working. They were protecting investors. And then, coincidentally, right before SpaceX needs to go public, those rules get rewritten. Now you might think, okay, maybe there's a good reason. Maybe markets change. Maybe the rules were outdated. Fair point. But here's the thing. This didn't happen through some normal regulatory process. There weren't massive public hearings about the need to change IPO rules. There wasn't a years-long study about whether these protections were still necessary. It happened quietly, behind the scenes, specifically configured to make room for SpaceX. That's not regulatory evolution. That's rule bending for a specific deal. And when you see rule changes happen specifically for one company, that's usually when you should start asking questions. Now, this leads to the bigger picture. Why does SpaceX even need to go public in the first place? This is actually crucial to understand. Because most companies go public for a specific reason. They need capital. They're growing fast. They need money to fund operations, build factories, hire people, expand into new markets. But SpaceX? SpaceX is already profitable. According to reports, SpaceX's revenue is in the billions. They're cash flow positive. They don't need capital. So why would they go public? The answer is exit liquidity. This is a term you don't hear enough about, and it's crucial to understand what's really happening in these mega IPOs. Exit liquidity means this. Early investors and founders want to cash out. They invested years ago, maybe at a valuation of a few $billion. Now the company is supposedly worth $100 billion or more. They want to realize those gains. They want the money. But here's the problem. When you own billions of dollars in stock in a private company, you can't just go to the market and sell it. There's no market for it. You're stuck. An IPO solves that problem. It creates a public market. It creates liquidity. And suddenly, all those early investors who have been sitting on these massive paper gains can actually sell their shares. This is where retail investors come in. When SpaceX goes public, where do you think the early investors are going to sell their shares? They're going to sell them to you, to the people who see the headlines, get excited, and buy stock on day one thinking they're getting in early. But you're not getting in early. You're buying the shares from people who are trying to exit. Think about the incentives here. You've been an investor in SpaceX for 10 years. You're sitting on a position worth $50 billion. Elon is going to go on CNBC and talk about how amazing SpaceX's future is. The media is going to pump the story. Everyone's going to be excited. And while everyone is excited, you're going to sell. You're going to dump your shares onto the retail market. You're going to take your profits and get out. That's exit liquidity. And it's one of the most reliable patterns in finance. When you see a mega IPO with huge hype, what you're actually seeing is a carefully orchestrated event where insiders are cashing out. But let's talk about the other side of this equation. Because SpaceX has a response to criticism. They say, look, Starlink is hugely profitable. We have margins over 30%. This is a real business, not just hype. And on the surface, that sounds convincing. Starlink does have incredible margins. The revenue is growing. It seems like a legitimate business. But here's where the accounting gets creative. Every time Starlink launches satellites, those satellites have to be launched on rockets. Those launches are incredibly expensive. A Starship launch costs hundreds of millions of dollars. And you need lots of launches to maintain the Starlink constellation. Now, logically, those launch costs should come out of Starlink's profit and loss statement. If Starlink is launching its own satellites, those costs belong to Starlink. But SpaceX has structured this differently. They've allocated those launch costs to the SpaceX rocket division instead. So on Starlink's financial statements, the company looks incredibly profitable because the biggest costs are hidden in another division. It's like a coffee shop that owns its own warehouse. Instead of charging the warehouse rent to the coffee shop's P&L, they charge it to the warehouse division. Suddenly, the coffee shop looks incredibly profitable. The margins look great, but the reality is, the business as a whole is much less profitable than it appears. This is legal accounting. It's not fraud, but it's misleading. And when you're evaluating an IPO, you need to look at the actual underlying economics, not just what the financial statements say. The underlying economics of Starlink are far less impressive than the presented numbers. But we're just getting started with the problems, because there's another issue that almost nobody is talking about, and it might be the most important one. Satellites don't last forever. These Starlink satellites have a designed lifespan. They're in low Earth orbit, which means they're experiencing constant atmospheric drag. Their batteries degrade, their propellant runs out. Eventually, they deorbit and burn up in the atmosphere. The lifespan of a Starlink satellite? About 5 to 7 years. Let's call it 5 years to be conservative. So here's the math. Starlink has launched approximately 10,000 satellites, 10,000, and every single one of those satellites needs to be replaced every 5 years. That means in 5 years, Starlink needs to launch 10,000 new satellites. That's roughly 20 satellites per day, every single day, for the next 5 years, and then the cycle repeats. Do you understand the scale of what that means? This isn't a one-time cost. This is a recurring, massive, ongoing capital requirement that doesn't go away. It's built into the business model. Think about what it takes to launch satellites. You need rockets, you need fuel, you need launch facilities, you need specialized manufacturing, you need supply chains. Every single day, you're launching satellites. Where does that money come from? It comes from somewhere. Either it comes from Starlink's operational revenue, or it comes from external capital, or it comes from other parts of SpaceX's business subsidizing it. Right now, SpaceX is profitable overall, but they're not necessarily allocating all the satellite replacement costs to Starlink. They're spreading them across the company. But what happens when SpaceX is public and investors are demanding returns? What happens when you have to account for all of those costs transparently? Suddenly, Starlink's profitability story looks very different. This is a long-term liability that's being hidden in the financials. Here's what's interesting about this pattern. It's not new. We've seen this exact playbook before. In the late 1990s, during the dot-com bubble, we had dozens of internet companies going public. Companies like Pets.com, Webvan, eToys, these companies had incredible ideas, revolutionary ideas. They were going to change how people shopped, how they received delivery, how commerce worked online. And the financials looked great. They showed growth. They showed market opportunity. They showed why these companies were worth billions. But the underlying business models were fundamentally broken. The customer acquisition costs were too high. The unit economics didn't work. The companies were burning cash. But the IPOs happened anyway, because by the time you go public, the people who benefited from the hype cycle are already getting out. The venture capitalists who invested in Round A at $1 million valuation sold their shares in Round B at $100 million valuation. They made their money, then Round C came in at $1 billion. They got more money out. Then the IPO happened at $10 billion, and the last round of private investors and early employees cashed out. And then, about 2 years later, the stock crashed 70%, and retail investors who bought at the IPO were left holding the bag. We saw this exact pattern in 2000. We saw it again with the tech IPOs in 2021 to 2022, and now we're seeing it again with companies like SpaceX and OpenAI. The pattern is consistent. Rule changes happen to facilitate the deal. Insiders get excited and hype the narrative. Financial statements look great. Then, 5 years later, people realize the underlying business wasn't as good as advertised. History doesn't repeat, but it rhymes. So this brings us to the next question. Why is this happening right now? Why is SpaceX going public now when they don't need the capital? The answer is timing, and it's connected to larger economic forces that you should understand. Right now, in 2024 to 2025, we're at a very specific point in the economic cycle. The economy has shown signs of weakening. Inflation has come down, but it's still elevated. Interest rates are high. Corporate profits are under pressure, and investors are getting nervous. In this environment, mega-cap tech companies have become incredibly valuable. They're some of the few companies that are still growing and profitable, so they've attracted massive amounts of capital. Valuations have gotten stretched, and when valuations get stretched at the top of a market cycle, what do smart insiders do? They sell. They diversify their risk. They realize gains. SpaceX going public right now is not a sign of strength. It's a sign that some very smart people think now is a good time to take chips off the table. Additionally, we're seeing a broader trend: index fund buying. When SpaceX becomes part of the S&P 500 or the Nasdaq 100, index funds are forced to buy the stock. This creates automatic demand. It pushes the price up, independent of the underlying business. This is another reason why mega-cap companies IPO right now. They know that index fund buying will create demand for their shares. It artificially inflates the stock price, which makes it a perfect time to sell early investor positions. So the macro timing is suspicious, and it suggests that insiders understand something about valuations that the retail public doesn't. Now, here's where this gets genuinely dangerous. And I want you to really think about this. When SpaceX goes public and becomes profitable, when it qualifies for the S&P 500, what happens next? Index funds have to buy it. Every single passive index fund that tracks the S&P 500 now has to hold SpaceX stock. This sounds good at first. You think, great, I'm getting diversified exposure to SpaceX. But here's the problem. Once SpaceX is in the index, you can't avoid it. Even if you think the stock is overvalued, even if you think it's a bad investment, if you own a passive S&P 500 index fund, you're holding SpaceX. This applies to your 401k. This applies to your IRA. This applies to every passive investing strategy out there. And here's the kicker. If SpaceX turns out to be a disappointing investment, if growth slows down, if Starlink's profitability turns out to be overstated, if the satellite replacement cycle becomes a burden, the stock could fall significantly. And when it falls, it's not just SpaceX shareholders who lose. It's everyone who holds the S&P 500. It's everyone in a diversified portfolio. It's retirement accounts, it's 401ks. This is called systematic risk. One bad company can drag down the entire market because so many people own it passively. So the real danger here isn't just whether SpaceX is a good investment. The real danger is that SpaceX becomes embedded in the financial system in such a way that a significant decline affects everyone. Now let's talk about why this works. Why do people fall for this pattern again and again? It comes down to human psychology. Specifically, it comes down to FOMO, fear of missing out. Here's how it works psychologically. You see headlines about SpaceX. You see news about Starlink revolutionizing internet. You see Elon talking about the future. You see venture capitalists getting rich, and you think, I'm missing out on this. This is the next big thing. If I don't get in now, I'll regret it forever. This feeling, this urgency is powerful, and it causes people to abandon their usual caution and due diligence. They buy without looking at the financials. They buy without understanding the cost structure. They buy because they feel like they have to get in. And this is exactly when they're most likely to lose money. Because the insiders who created this hype, they're not thinking about FOMO. They're thinking about valuations. They're thinking about exit opportunities. They're thinking about how to maximize the price before they sell. So they deliberately create hype to push the stock price higher on day one. Hype drives demand. Demand drives price. Higher prices make it easier for early investors to exit at attractive valuations. But here's the thing about FOMO-driven price spikes. They don't last. They're usually followed by disappointment, because reality doesn't match the hype. We've seen this so many times. Remember when Slack IPO'd and everyone said it was going to revolutionize workplace communication? The stock initially soared. Then, over the next 5 years, it lagged the broader market significantly. Remember Peloton? Everyone said it was the future of fitness. The stock IPO'd and soared. Then demand crashed, and the stock lost 90% of its value. The pattern is hype creates demand. Demand creates price spike. Insiders sell, new buyers buy high. Stock underperforms, people lose money. And we're about to see that same pattern with SpaceX. Now, I want to be fair here, because SpaceX advocates have some reasonable points. They say SpaceX is genuinely innovative. They're not just hype, they've actually revolutionized rocket technology. Reusable rockets are real. They've reduced launch costs by 10 times. That's not speculation, that's happened. Starlink is also real. Starlink is bringing broadband to places that don't have it. That's a real service that people need and want. And they say Elon's track record, while mixed, does show that he can build things that seem impossible. Tesla seemed impossible at first. Now it's one of the most valuable companies in the world. So maybe, they argue, SpaceX could be different. Maybe this time, the fundamental business really is as good as advertised. And you know what? That's possible. I wouldn't bet against that. I wouldn't say it's impossible. But, and here's the key, even if all of that is true, even if SpaceX really does become an amazing company with huge profits and incredible growth, that doesn't necessarily mean the stock is a good investment at the IPO price. Because valuations matter, timing matters, entry price matters. You can have a great company with a terrible stock price at a certain moment, and a mediocre company with an amazing stock price at another moment. The question isn't whether SpaceX will be successful. The question is whether the IPO price reflects that success, or whether it's inflated by hype and exit liquidity. And based on the pattern we're seeing, the rule changes, the profitability accounting, the timing of the IPO, the insiders getting out, I'd bet it's the latter. So here's what I'm actually recommending. If you're listening to this and considering buying SpaceX stock, don't do it on day one, don't do it because of FOMO, don't do it because everyone else is doing it. If you believe in SpaceX as a long-term investment, then wait. Wait for the initial hype to die down. Wait for the stock to stabilize. Wait 6 months. Wait a year. Wait for the fundamentals to become clear. Because one of two things will happen. Either the stock will continue to rise, in which case you haven't missed anything. Growth companies can grow for years. Or the stock will fall back down to more reasonable levels, in which case you'll get a much better entry point. Either way, you win by waiting. But if you jump in on day one because of hype, you're making a decision based on emotion, not analysis. And emotion-based investment decisions are almost always bad. Second, if you're a passive index investor, understand that SpaceX will be in your portfolio whether you like it or not. You can't avoid it. The only thing you can do is stay disciplined with your investment plan, keep your allocation diversified, and resist the urge to make emotional decisions if the stock falls significantly. And third, ask yourself the question I posed at the beginning. When you're thinking about buying SpaceX stock, ask yourself, am I investing in a great company? Or am I just the exit vehicle for someone else? If you can't answer that question clearly, then you're not ready to make this investment. Because the difference between being an investor and being a mark is the difference between understanding what you're buying and just following the crowd. And in the case of SpaceX's IPO, understanding what you're buying means understanding the exit liquidity, understanding the accounting, understanding the satellite replacement cycle, and understanding that early investors have massive incentive to push the price as high as possible before they bail out. So be careful, be thoughtful, and remember, great companies don't always make great investments. And IPOs with rule changes, questionable accounting, and mass insider selling are exactly where people lose the most money. Thanks for listening.